Greetings from 3Edge Asset Management, and welcome to the 3Edge Week in Review for the week of November 9th, 2020. I'm Fritz Folts, the Chief Investment Strategist here at 3Edge, and I'm pleased to be joined here today once again by Steve Cucchiaro, President and Chief Investment Officer here at 3Edge Asset Management. This week, Steve and I will provide a brief recap of the global capital markets activity, and then we'll take a closer look at the corporate bond market and the recent and rather dramatic buildup of corporate debt, along with some insights into credit spreads. We have a great deal to cover today, so we'll get started. I'll bring Steve right into the conversation here. So Steve, a lot of news really over the past week plus. We have the U.S. presidential election, which is now almost behind us. However, there's the runoff elections in January for the U.S. Senate, which I guess will decide which party controls the Senate. In addition, obviously, we had the positive news on the vaccine front in terms of coronavirus, but at the same time, really facing what looks like a powerful surge, fall-winter surge of the coronavirus. And lastly, as we reach the midpoint of November, markets are doing pretty well, global equities right across the board. So what should we be focused on here in the last weeks of 2020 and as we make our way into 2021?
I think you're right, Fritz. The fear of a contested election is receding. We did get that announcement about the Pfizer vaccine that was very encouraging. And at the same time, before we're all going to get to use that vaccine, it looks like COVID deaths are climbing quite rapidly. And the IHME came out with a new forecast saying that cases and deaths are likely to continue to accelerate until at least mid-June. So that's not great news. But I think we'll see continued volatility because we will get more updates on vaccine trials, not just Pfizer, but other pharmaceutical firms that have vaccine trials ongoing. And that will cause some market impact. But also we'll continue to hear more about the coronavirus itself in the short term and the increase in cases and deaths. So I think we're in for more volatility.
Excellent. All right. So during last week's video, we mentioned a couple of times credit spreads and how credit spreads are an important factor in our research model. So I thought maybe we could spend some time today talking about the corporate bond market and the concept of credit spreads. And so just to tee this up a bit, if you will. So when an investor invests in a corporate bond, they're lending money to a corporation, as opposed to lending money to the U.S. government when investing in a U.S. Treasury bond. Now, the U.S. Treasury security is considered to be risk-free, at least from a credit standpoint, because the government can always print money to pay you back. In the corporate bond market, you're lending money to a company. They're obviously not able to print money the way the government can, and the company could run into financial trouble. They could even go bankrupt. So therefore, you are seen to be taking credit risk when investing in corporate debt. And for this risk, you need to receive a higher rate of interest on your corporate bond, which brings us to credit spreads, which is simply the difference in yield between two bonds of a similar maturity but different credit quality. And I'll give just a quick example. So if you have let's just say you have a 10-year U.S. Treasury note and it's trading at a yield of 2%, and you have a 10-year corporate bond is trading at a yield of 5%, the corporate bond is said to offer a 300 basis point spread over the Treasury. And so in this case, the investors are being compensated for taking that credit risk to the tune of 300 additional basis points difference, and this is referred to as the credit spreads. So with that as a bit of background, let's talk a bit more about the corporate bond market writ large, which has experienced a massive amount of debt issuance, right? And what is happening also with credit spread, because they seem to be very, very narrow currently. So what do you see in store for us in terms of the corporate bond market, or potentially in store for us there?
Well, just as an example of how extreme things are, Fritz, right now, if you were to invest in the lowest quality companies, which give you the highest yields to accommodate the fact that they have low quality, the interest rate that you would receive right now would be at an all-time record low, lower than any time in history. That's quite extreme. And I would attribute this to the following, that investors, rightly or wrongly, are conditioned to believe that the Federal Reserve Board will continue to come in and rescue the bond market the next time there's trouble, just like they did in March and April when there was big trouble in the bond market and these credit spreads widened dramatically. So they came in and rescued the situation by buying some corporate bonds, first time they ever did, and also announcing that they wanted to support the bond market. So this has led to a complacency, almost a moral hazard, where bond investors are not looking so much at the risk side of the equation. Now, having said all that, all the central banks in the world that made this unprecedented rescue printed a few $1 trillion. In fact, the Fed themselves printed $3 trillion, and some of the other central banks printed, also $1 to $2 trillion each. And when you add that all up, you have several $1 trillion. Well, that's a lot of money, but it pales in comparison to the entire global bond market, which sits at about $300 trillion. So it's not right to think that Federal Reserve Board or central banks can fix all the problems in the bond market. It would just be too overwhelming. So the other point that's worthy of mentioning is that while the Fed can lend money, they cannot spend money. So they have been talking to the market saying, look, right now, the next step is to get the government to pass a fiscal rescue package, because it's only the government that can spend the money and protect the companies if there's another downturn. And yet, right now, we have gridlock in Congress. So just to give an even clearer picture of how extreme the situation is today, I'd like to show everyone this chart that we put together. And this chart goes back from 1986 to the present. It shows what we call the corporate debt cycle. And it's basically a ratio of the amount of corporate debt or borrowing as proportion to the size of the economy, or GDP. And those shaded areas are where the recessions hit the economy. And what this corporate debt cycle is all about is the following: that prior to a recession, when times are good, when the economy is growing, when there's increased confidence in companies' ability to pay their debts, credit spreads tighten. People are willing to invest in those companies and they worry less about the risk of getting paid back. And when that happens, companies are encouraged and able to borrow more money. And so you see the line go up on the cycle in the chart because they're borrowing more money, everything's good. And then, of course, companies get to an extreme, recession hits, and all of a sudden, companies realize they can no longer sustain the amount of borrowing that they took on. Investors are not willing to lend them at the same rate because now with the recession, they're worried about the economy going down, about companies not being able to earn as much, not being able to pay off their debts. Credit spreads widen, and that makes companies less able to borrow, less able to roll over their financing, and they end up deleveraging or paying off their debts. That causes the economy into a further downturn, and it's a vicious cycle. Well, we've seen these cycles from 1986 to the present, up and down, up and down. And then when the recession hit, we were at an all-time peak, and the credit spread started to really widen. Then we had the massive intervention by the Fed. And what you see on the right is an enormous spike higher, unprecedented, never happened before. And right now, the amount of corporate borrowing is much higher than ever before. And so we want to point this out because it's a sign that the next time a downturn comes, it's going to be harder and harder for the Fed to be the only backstop.
Right.
And companies are really on a limb right now. And if they cannot pay this higher and higher level of debt, credit spreads will widen. And anybody that buys corporate bonds now will be suffering a loss in the principal value of their bonds because as the credit spreads widen, people won't pay as much for those bonds as they did.
Wow. All right. Well, that is sort of a scary chart. And once again, introduces the idea that when there's just too much leverage in the system, you have to be careful that if you have a problem, it just exacerbates any problem that you have. But that's really, really helpful. And I think really insightful and something that perhaps not a lot of investors are focused enough on. So thank you for that. And that will do it for us, actually. Steve and I will be back again next week, another edition of the 3Edge Week in Review. As a reminder, all of our videos always available on our 3Edge YouTube channel, and feel free to subscribe to the channel in order to receive notification as we release videos in the future. If you would like to submit any questions to us or topics for a potential topic for a future Week in Review video, you can send that to us to weekinreview@3edgeam.com. Steve, thank you again for your valuable insights this week.
Thank you, Fritz.
And on behalf of everyone at 3Edge Asset Management, we urge everyone to remain safe and healthy, particularly as this coronavirus surges through much of our country during the fall and winter months. And keep the faith, and thanks for listening.